mortgage rates might fall, but that's the least important. When the Fed cuts, money moves. Now, some people might get crushed by inflation, but others, they might ride the wave and get richer. Now, in this video, I'm going to show you how you can set up your portfolio and benefit from what happens after. Let's jump in. As always, I would really appreciate it if you like this video and if you subscribe to my channel. Now, let's take a look what the Fed actually controls. Very first and foremost, it controls the funds rate. So what is the actual rate that is set? And we'll get into that in a moment, which ultimately, so this fund rate actually controls the bank funding. So how much does it cost for a bank to extend a loan to an entity, whether it's a business or an individual? And this ultimately then flows down to retail rates. Now, retail rates could be anything from you obtaining a mortgage. So what is the rate on your mortgage? What is the rate on your auto loan, on your credit card, etc. Now, as you may have heard, on September 17th, the Fed actually announced its very first rate cut in 9 months, almost a year, and that ultimately also signals further reductions. Now, 98.1% of folks thought that it would just be a 25 basis point rate cut, and they were absolutely right. Others thought, or the remainder of the 1.9% of folks thought that there would be a 50 basis point rate cut. Now, while that didn't happen, the 50 basis points rate cut or 0.5% rate cut did not happen just now, it might actually still continue to happen. So another 25 basis points might be cut in the future. Now, I wanted to show you what the actual impact of interest rate cuts are. So let's take a look at this. When the Fed cuts rates, it actually impacts borrowing costs. So let's actually jump back up to this point here. The Fed controls the rates, right? And like we said in this chart, the rates really impact how banks or how much banks can extend lending or debt to other people or entities and how much that debt costs. So the cost of that debt ultimately goes down when the Fed cuts rates. Now, when the price of, for example, a Ferrari goes down, well, I don't know about you, but I would probably be in the market. I would be excited to get that Ferrari. So what does that mean? More buyers jump in, which ultimately means the demand increases. If so many people want a Ferrari, well, what does Ferrari think? Well, guess what? They're going to be like, we're going to take advantage of this increased demand, so we're going to increase prices. So ultimately, prices go up because that's just the nature of asset price inflation, right? So now ultimately we're dealing again with inflation. So as you can see, this is a cycle, and that's how the Fed responds to perhaps a slowing economy. Now, if the economy is slowing and the Fed wants to stimulate the economy, one of the things it can do is cut these rates. And cutting the rates ultimately lowers the cost of that capital, like we just spoke about. In addition to that, it can also increase property values. So possibly you might actually see your home value increase. Why? Because again, lower rates means cheaper borrowing costs. So more people can get cheaper mortgages at a lower rate, which ultimately increases demand. Again, if more people want something, well, that again drives up the asset price. And finally, it could also mean stronger competition for assets. Again, if 500 people or 5 million people all of a sudden want a Ferrari, there's more competition, and Ferrari can take advantage of that and drive up the price of their asset, in this case, their car. And that can also relate to stocks. It can relate to real estate and so on. So the asset valuations really do expand. So it is a way, with the Fed cutting rates, it is a way for the Fed to actually expand and stimulate the economy, because that means they might actually think that the economy is slowing down, which a lot of folks have said in the past. Now, there is a downside, though. The first downside is that lower rates actually reduce your savings yield, and it can reignite inflation, just like we were talking about before, right? Here in this cycle, when prices go up, well, typically that leads to inflation. So it's just a way to stimulate the economy, but the cycle will happen again. So I did want to show you this chart as well. And this year is a little bit outdated, so it's in 2023, so take it with a grain of salt. However, I wanted you to see how savings account rates, so to address this very first point, how lower rates can actually reduce your savings yield. So if you have a high yield savings account, this is very important for you to know. I wanted you to see how this savings account, in this case Ally Bank, actually follows or tracks how the Fed has lowered or increased its fund rate. So Ally here is in purple and the Fed fund rate is in orange. So as you can see, and it makes sense, the Fed typically is the leading indicator. So it's actually the first of the two to make a move, which makes sense because the Fed really does control the rates. And then pretty much in lockstep, maybe not completely in lockstep, but the savings account also decreases. So when the Fed decreases, which is more rapid, the savings account decreases. And when the Fed increases again, the savings account increases. So what I'm saying with this chart and what this means for you is if you do have a very large chunk of cash sitting around in a high yield savings account, for example, perhaps it's over your 3 to 6 months limit, you might actually want to move some of that cash into the stock market because potentially the stock market might be stimulated again to move up in asset price valuation. Could be. So just keep that in mind that you probably won't get the best yield anymore as rates continue to drop. So why is the Fed actually cutting now? So here are the three main switches that I think are important to know. First are job wobbles. So we've actually heard about, the labor market not being as good as at least originally thought to be. There have been several revisions, and those revisions, they have been weaker, unfortunately, than initially thought. And that means that it's harder to get a job. Now, if businesses want to expand, they want to increase employment. And how do they do that? By getting access to cheaper debt. If the debt is cheaper, businesses are likely going to invest that in infrastructure, technology, and in labor, and in people like you and me. So chances are there would be an increased employment. Also, tariff uncertainty is starting to decrease with a cut in rates. Why? Because typically, if the rates cut, that shifts the focus from inflation. So typically, if the rates are higher, that means that there might be, inflation risk. They're trying to counterbalance inflation. So with these rates being cut, there's no more focus on inflation risks caused by tariffs. Rather, the focus is being pushed toward the labor market, right? So there also is less inflation risk from trade. So the tariff uncertainty is starting to decrease with the rate decrease. And then finally, it's also able to spend or to steady the spend because again, there is the debt is cheaper. So that means the consumers and the businesses are able to fuel the economy. And in this case, the GDP. So those are the three main reasons. Now, who are the winners and the losers in this particular situation? So let's take a look at the possible winners. I like looking at the winning side first. First, we're going to look at duration-sensitive assets. So these are assets like bonds, for example, that are pretty sensitive. And if the rate cuts, it could help them. Refi-sensitive plays. So for example, if you're looking at a refinance for a house, a mortgage, for example, or student debt, well, if the rates are lower than what you got the original debt at, this could actually help you save quite a bit of money. So anything that's refi sensitive that used to be at a high rate and now might be at a lower rate, you might actually make money or at least save money. And then finally, debt heavy but solvent firms. So these are firms that actually did pay a lot of money toward higher interest rates, but now with the rates coming down, it might actually help their cash flow. Those that are possible losers. Pure cash savers. So if you just have a high yield savings account, well, if you remember the chart that we just looked at with the Ally savings account versus the Fed right here, you might actually, unfortunately, be in the losing camp. Why? Because as the Fed decreases, your overall yield in your savings account also decreases. Now, this might not just apply to HYSAs. It might apply to anything that's cash similar. Late cycle leverage. So anything that has a variable rate and it's a debt, it's typically risky, especially if your income, so how much you make, is still shaky. In other words, it's kind of cyclical, right? So if you don't have a steady income stream and you have variable debt, it might actually cause a little bit more pain, right? Taking on debt when the economy is getting tired. And then finally, if you have hope small caps with weak balance sheets. So, the refinancing risk persists. So if you are refinancing, you may have a higher interest rate and small companies might not be able to actually pay if it is variable, right? So if the company refinances and it is variable and then the interest rate goes up and the small company is unable to pay, that could cause it into bankruptcy. So let's take a look at the rate framework. So the rate framework is 4 pieces. So those four pieces are R for rebalancing liquidity, A for adjusting for duration, T for targeting sensible leverage, and then finally E, establishing by trigger. So let's actually go into what each of these four items mean. So first, for rebalance equity, there are really three components, right? First is the emergency fund. You want to have about 3 to 6 months in cash. Typically, if you are more risk averse, so you don't like taking risks, 6 months is probably on the better side. If you are likely to take more risks and you're comfortable with risk, 3 months can be better. So you want to have some sort of emergency fund. You want to have core DCA, core dollar cost averaging plan in place. This is one that essentially auto invests into really broad market index and ETF funds. One of them being the S&P 500, right? As well as an ETF that I at least use, which is ETF, that is VOO, and there's a couple of others as well. So that's one. And then finally, you want to look at opportunity because you do want to have a percentage earmarked for dislocations, or in other words, when your portfolio is no longer up to par with how it was originally allocated. And this is called portfolio drift, right? So when portfolio drifts, that means when originally you had a portfolio allocation that was, let's say, a 70-30. So 70% of your assets were in stocks, 30% in bonds or cash. And then when, let's say, you invested it, there maybe over a couple of months or years, the portfolio might have drifted to perhaps an 80-20. So the stocks, what happens is typically stocks grow faster than bonds. And if they do grow faster, that means the value of your your money invested in stocks also expands, and that ultimately pushes it to a higher allocation. Now, if that happens, you might want to, sell the additional 10 percentage points from 70 to 80% and reallocate to the 20%. On top of that, if there is anything going on in the stock market, you do want to have that opportunity. You want to have that cash ready to go as dry powder and invest. As yields fall, you can consider trimming excess idle cash beyond bucket one, so beyond this emergency fund. So, for example, what I did, and these are just ideas from my own success. Obviously, every person is different, so make sure you remember that as you invest, right? So if you don't feel comfortable with one thing, go with what you would do for yourself best. But from what I did, when I saw an opportunity, like when COVID came and the stock market crashed by 20%, I took my dry powder. So I did keep a percentage of earmarked cash during this COVID dislocation or crisis. And I went ahead and I stuck that cash into the actual stock market, right? Into the stock market while I was still doing my DCA plan. So I was still DCAing, but I gave myself a little boost with that cash. And that's how I helped not only trim excess idle cash in my emergency savings fund, but I also helped myself by, investing when it was low. And now, a couple of years later, it's actually doing quite well. All right, so now let's take a look at the A in the framework, adjust for duration. Now, to give yourself a little bit of a context, but duration is essentially the measure of the sensitivity of a bond. So anytime you hear duration, think of bonds, right? So duration just measures how sensitive that bond's price is to fluctuation in interest rates. And oftentimes they can be quite sensitive to interest rates, right? Whenever the Fed changes the interest rate, a bond might be more impacted than a stock. Not always, but sometimes. It depends on the type of bond. And this is generally measured, duration is generally measured in units of time. So generally you have short-term bonds or short-term duration, you have mid, and then you have long-term, right? Long-term is like about 30 years, mid-term is maybe like 5 to, 30, and then short is like typically 1 month to maybe like 2 years or something like that. So I should change this to 2. So that's generally what this means, right? And that's generally what duration means. And then finally, this is a little bit more technical. I'm going to skip over this, the Macaulay duration, but we're not going to focus on that. It gets too technical for the purpose of this video. This chart I thought did a good job visually speaking for understanding duration. There are 3 items in this chart to focus on. First is the coupon rate. So how much does the bond cost? What is the term to maturity? So how many years until it matures, and that means you get your money back from your investment. And then yield to maturity, like what is the actual yield, which is a percentage. So if the yield is lower, so this is kind of where we are now with the interest rate environment, and let's say it is very long to maturity, let's say it's a 30-year bond, well then it might be pretty high, medium to high volatility depending on the coupon rate. The coupon rate, I don't know, I can only guess, but if the coupon rate is low, then you have medium volatility to high volatility given the interest rate environment we're at right now. And here you can look as well, here's 2-year, which is short term. You got a medium term, and then you got a long term. So the duration, the sensitivity of a bond's price change in yield, if the yield goes down, which again is impacted by interest rates, if that goes down, then you can see that the price goes up. So this is just another chart, visually speaking, to show you how duration can actually impact the price of a bond. So ultimately, if rates do trend down, longer duration benefits more with risk tolerance. So there is more up and down in this longer duration. Equity duration, on the other hand, growth quality with earnings visibility may see multiple relief. So again, it's an up and a down, and it really does depend on the type of bond and on the type of stock that you invest in. Some might be more risky, some might be less risky. Okay, the target T stands for target sensible leverage. So the good part is, it's fixed rate, long-term, and affordable payments. But what you want to avoid is essentially variable rate traps. Maybe the rates are down right now, but maybe they actually go back up very short term. And then you also want to avoid these short-term mortgage balloons. You want to avoid that as well, because who knows? Maybe, again, rates go up and the balloon could burst. And then finally, E stands for established buy triggers. So this is creating a framework for yourself without needing to involve your emotion. So whenever you see an up or down, a swing in the stock market, you do not want to invest on emotions. You want to invest based on these buy triggers. So for an example, I used an if-then version. If something happens, then I'm going to invest this much. So if the stock market goes down negative or goes down 10%, I'm going to add 25%. If the stock market goes down 20%, I'm going to add 50% of my typical contribution. For me, that's a DCA plan. So what is my DCA plan? Let's say I put in $100. Well, I'm going to put in $150 because that's 50% if the stock market goes down 20%. So make sure you have these pre-commit rules, which ultimately prevents emotional turmoil, which also prevents this effect of FOMO. Some people consider FOMO in a down market getting out of the market because they don't want to lose their money. Other people consider FOMO as putting all their money into the market. Now, of course, I think one is probably better than the other. However, before you do an all-in into the stock market, you do want to give yourself maybe a cool down period. That's what I would suggest. Give yourself a cool down period of maybe 24 hours or so before you pull any massive trigger, whether that's putting all your excess cash into the stock market, which can be risky because if you do have an accident or maybe a vet bill or something unexpected and you don't have any cash on your hands for reserves, you're going to go into credit card debt, which is what we don't want. So make sure before doing, being all in or all out of the stock market, give yourself a cool off period. So where the next moves might show up, where might these next moves show up? So first, bonds and income. So these might relate to laddered treasuries. So consider modest duration extension. So laddered treasuries are, are short term, and then you buy certain treasuries, and this is called laddered. So this here is the term. And instead of buying just a really long-term treasury, you kind of split it up into short-term, medium-term, and long-term treasuries. You lock alternative yields before they drift lower. So if you want good yields, that's when you lock them in now. because they might drift lower as interest rates go lower. Equities is another one. So you want to keep DCAing. Like if you are a DCAer like me, then you want to keep that plan. But some additional ideas on top of DCAing is, what type of quality stocks are you looking for? Are you looking for rate sensitive investments like real estate investment trusts, for example? Are you looking for small or mid size businesses or companies with very strong balance sheets? Maybe you can invest in them, because all of these might mean if the debt is cheaper to access, they might see expansion or an increase in their asset price. Housing and refinancing, that might see another change, which is lower rates can spark refi waves. So refinancing, if you have a 6% mortgage and now the mortgage is all of a sudden worth, 4%, you can save a few $100s a month in your payments. So you could expect some refinance waves and activity if the affordability of the housing market obviously improves. And then obviously you want to beware of if demand surges because it's so cheap to buy debt, to get debt, that could push prices up, and there might be an affordability tug of war. And then finally, cash alternatives. Expect if the Fed lowers the rates, then the high yield savings account yields might fall. So you can shop CDs or short-term treasuries while windows are still open. Now, finally, some additional FOMO rules. First, don't do any all-in, all-out moves, just like I said before. Scale in or out per your pre-written rules that I mentioned up here, right? So it's very important. So use this if-then framework to help you make these rules before you're in the middle of a potential bear market or recession. Make sure you set yourself a cool-off timer, like I said before. Give yourself 24 hours before changing an allocation. In this case, I said even greater than 5%. Of your portfolio. It could be more than that, but make sure you give yourself a cool-off timer, especially if you're planning to be all in or all out. And then finally, give yourself a monthly process check, right? So how did you do with your DCAing? Did you rebalance your portfolio at all? Did you follow your pre-written rules, your triggers? It's really important because discipline compounds like capital. In fact, it was Warren Buffett who said that an idiot with a plan will likely do better than a genius without a plan. And that's so true. And I've seen that time and time again, even with my own clients when I was a wealth advisor working with millionaires. It really is true. So focus on that discipline. The most important thing is start building wealth now. So if you found this video helpful, please like and share to help others, especially if you learned something new. Make sure to subscribe to my YouTube channel. It's at @_MMW for more cool insights. And of course, join my newsletter for more exclusive tips. My newsletter is pinned in the top comment below. And your bank accounts will thank you later. Thank you so much. Bye-bye.